Okay, so good morning, everyone. Welcome to the new week. This is the macro snapshot. We are Monday, March the 24th, 2025, recording this early in the morning. Okay, so we've woken up a little bit to sort of a risk on, a bit of a risk on sort of sentiment. You can see here, if we look, let's say at the ES futures, you can see they're sort of quite nicely green above the 200-day EMA. They're interestingly enough, they're getting up towards the simple moving average, the 200-day simple moving average. So it will be interesting to see if the market wants to push above that. That's also a 38% fib retrace level. And basically, we've got a bit of a risk on. We've got some, the equities up. We've got the risk currencies up. We've got bonds down a little bit. Just because over the weekend, there were some headlines or kind of sort of rumors, stories that the Trump administration, the famous sort of April the 2nd Liberation Day, would not be universal tariffs on every single country at the same level, but would be much more targeted, probably less onerous to begin with. So the point is that the market has taken this as being a sort of a positive, that Trump is not going to sort of, bring a sledgehammer to global trade immediately, at least, and that the tariffs will be, as I said, less onerous than originally feared. We still have a sort of a week and a half. What is it? About 7, 8, 9 days before April the 2nd. So a lot can happen. Is this sort of posturing? We shall see. But the point is, we've had this nice sort of technical bounce now up towards the 200-day simple moving average on the ES, the mini futures here. So let's see if it gets above that. But what I want to do is just to sort of step back a little bit and just sort of look at sort of the bigger picture. So first of all, let's just look at what the Fed had to say the other day, because it's been a couple of days, so we've had enough time to absorb that. And where do I have that? I think I have that possibly here. Yeah, I've got a few things up here, guys. Forgive me. Okay. Yeah, so if we just look here, it's sort of interesting what the Fed is saying, and we know that we can take this perhaps with a grain of salt or so. But what the Fed is basically saying, there's going to be sort of quite high nominal GDP. So if you look at this, they've got a change in real GDP of 1.7. So I know that came down from 2.1, but it's still a real sort of expansion of 1.7. But if you put that together with the core PCE of 2.8, you get a reading there of what's that, about 4 point, what's that? Hold on, 4.8. Yeah, about 4.5 nominal GDP. So that's at least over 4 nominal GDP expansion, which is quite strong. So which is quite a lot of growth. So is that going to be feasible? I mean, is that actually a sort of a fantasy, or is that going to be feasible? I suppose it would be feasible and possible if the tariffs are not too disruptive. They're not universal. They're not at 25%. They're very specific and targeted, and sort of maybe revised downwards and subject to a lot of negotiation. Is such a growth as the Fed is projecting feasible? Okay, maybe the tariffs are not too disruptive. Maybe the deficit spending continues at quite a high pace, and actually the Department of Government Efficiency, the so-called DOGE, doesn't actually come in and spend and cut too many sort of spending programs. Maybe there will be a huge amount of deregulation, so a lot of there'll be some sort of productivity boosts. That's possible. Maybe the tax cuts will actually be extended, and who knows, even sort of deepened. We have to see if that's going to happen. It's possible, and all of that could lead to, let's say, a boom in bank lending and private sector sort of investment. So what we could get is like a real, rather than money sort of coming from the public sphere, it could be sort of in the private sphere. And so could we get some kind of 4.5% nominal GDP growth over the course of this year, which is in fact, as we see, what the Fed, in theory at least, is sort of penciling in. But I think also, and that's all possible. So they're the things we have to be really looking for over the next, sort of weeks and months, is the data and information about tariffs, the deficit spending, deregulation. Is the tax cut going to be extended? The tax cut going to be extended? And are we, going to continue to get sort of private investment and bank lending? Let's keep an eye on all of that. Now, what could upset that sort of thesis? So, no to this kind of nominal growth could be, let's say the tariffs actually are imposed, and even if they're not, sort of 25% and universal, they do cause substantial sort of chaos. There is a slowdown in trade. There is a slowdown in growth, and maybe even a sort of a mild mild recession. Who knows? Maybe actually under Elon Musk, the Department of Government Efficiency will actually continue to eliminate a substantial amount of jobs. There will be a reduction in government spending, and the deficit will come down. And that's possible that that too will help cause a sort of economic slowdown. And maybe there will be some kind of sort of small recession, as I say. So there are risks. So it seems to me that the Fed here, now that I think about it, they've sort of projected, as I say, about a 4.5% nominal growth. Pretty optimistic. But as Powell himself said, they have a huge amount of uncertainty. So you have to say that the other possibility is potentially, a relatively serious kind of sort of recession, or at least let's call it a serious sort of slowdown. So it's kind of like a binary kind of situation there. So does that mean that, if we get a recession, we could have not just 2.5 cuts, which is currently priced in, but maybe something more like 3, 4, 5 cuts. And it's kind of interesting if we look at the dots here, which I think are down here somewhere. Yeah. So if we look at the dots here for 2025, as you can see, the median number of participants are calling for, about 2 cuts or so. But so it seems to me that we could have a sort of bifurcated situation where maybe we'll only get 1 cut if there's no recession and the economy booms and everything Trump says he wants to do actually comes to pass. Or it actually could be much more down, sort of like down here, or so we could get sort of 4 or 5 sort of cuts. So that's going to be what's going to be very complicated. Well, not just sort of difficult to ascertain over the next few weeks and months, is just exactly which way the economy is going. But it does seem to me that the chances of a binary outcome are not great. And this whole idea of having 1 or 2 cuts, is maybe actually probably in a certain sense maybe the least a plausible outcome. I think we're going to have a stronger economy, as the Fed is, signaling in their in their summary of economic projections, or we could actually have a pretty serious slowdown. On the other hand, of course, with the higher growth, maybe we'll get no cuts. But in that case, though, the nominal yields and the real yields will definitely be quite a lot higher. So putting that all together, I think the main thing to take out is that there's definitely a very low level of confidence at the FOMC, at the Fed. We have an incredibly high dependence on data. And so therefore, as we have a high dependence on data, it's not so much sort of, smooth sort of monetary policy transmission driving everything, but it's really going to be sort of very data dependent. So it's going to be sort of quite technical, it's going to be range bound, and it's going to be choppy. So I would say that, until and unless we start getting, important data, and we do get the PCE, we get a little bit of data this morning, we get the PCE at the end of the week. But until we really get sort of CPI and employment data and this kind of thing, I think we're going to be, it's better to be trading this market pretty sort of technically. Excuse me, just need my morning tea. Okay, so let's actually look at a few charts and see what's going on. I just want to start with the bond market here. So let's look at, where are we? Let's have a look at the chart here. So if we go at something which is talking about the Fed, or very sensitive to the Fed, let's say the US 2-year yield. So let's bring it up here. So we've got these 2-year yields here. So I'm just going to bring close. Sorry, a lot of stuff you can't see, which is actually on my desktop here. So let's get those EMAs. So this is the 2-year yield, which of course is the one which is the most sensitive to policy. And I think at this point, we're probably going to be sort of ranging, around about, let's say 405, to 410, something like that. So let's have a look here at about 405 to 410. So if we get a yield up there, I think there's probably going to be buyers. So if we do get those yields going up, and of course that's a dip in the prices, they're going to be buyers. So let's say up at around about 405, 47, 408 in this zone here. I think that could be an opportunity there to sort of be buying. But on the other hand, you would keep in mind that level there at about 410, it's still quite a lot below general collateral. So like overnight sort of financing rates, repo rates, that kind of thing. So the question you have to ask yourself is, why would a big institution want to be losing money on the funding cost or the carry, right? So in the sense that the 2-year, you may be getting sort of 410 or 412 or 408 or something, but shorter term bills, you'll be getting a little bit more money. So you're losing money actually on the carry there. So again, Will there be buyers there? Probably, but the only way that buyers will come in very, very significantly at that level, like in big size, is probably if we get data which is supporting much lower yields. And of course, we have to see if that happens over the next sort of few weeks or months. So at that point, though, if you get very sort of weak data, which would imply that over the next 6, 12, 18 months, the Fed could be cutting, then at that point, the carry situation doesn't become such a problem because people are not worried about losing, a basis point every week or so if they're trying to go for 20, 30, 50 basis point moves. So you see the point is that until and unless we get strong data, the market's going to be focused on quite technical issues about, general collateral versus what you're getting for the two-year. And it's only going to be sort of heavily bought up at these levels is if, as I say, people start worrying less about sort of technical issues about carry and funding costs and start thinking that the two-year yield might actually sort of go down to, much down to these levels. So that's the interesting thing there. But if you look at, let's say, something like the 10-year, which the yields are also going up as well, and the 30-year, so that's like the ZN and the ZB, you're not really losing so much money on the funding or the carry. So that's less of a problem because there is a little bit of steepness sort of in the curve. So that's less of a problem. So this week we also have the auctions. We have a big chunk of 2s, 5s, and 7-year auctions. So mainly sort of focused at the front end. So putting together the fact that we have a big supply of auctions coming in and keeping in fact that, again, if you go back to something like the 2-year, you've still got yields on the 2-year paying a lot less than sort of a general collateral or under the general collateral kind of costs. So it just seems to me that the 2-year, or let's say the front end of the curve, could be under a little bit of pressure this week, and we might actually have a little bit of a sort of flattening there, just looking about that. Okay, so it could be a little bit of flattening, as I say, just for the next 3 or 4 days. We shall see. Okay, so let's just again look at the 10-year here, and we see that if we go up to if the yields go up to, let's say, for up here a little bit more, 435, 436, we could have some buyers. On the other hand, if it comes down to these levels, let's say 413, 14, 15, in that sort of range, between about, let's say, 415, 435, about a 20 basis point range, I do believe if we go down there, there could be sort of sellers down there and sort of buyers up there. So again, until we get very strong data indicating either that binary sort of growth or we get that sort of evidence of a slowdown, I think the 10-year could be in that range there. What's interesting, if we go, let's say, to the 2-10 yield curve here, it could sort of flatten down a little bit, as I was saying, down to maybe this level down about here, which is, the sort of the 100-day moving, exponential moving average, down to about plus 20 basis points here. Maybe a little bit, but that's about it. 5 or 10 basis points flattening. Again, just because we have a lot of supply coming in the front end this week, and it's still not paying enough in terms of yield. So, but I do expect maybe a little bit of a flattener is possible. The other thing, if we look at, let's say, the 5s and 30s, which I'll just bring up here, there's the 5s, 30s, then that's been steepening a little bit. And that's getting up towards resistance. I mean, I think it's going to be hard at this point to get up, more than sort of, let's say, 63, 64, 65 basis points just up there. But it does seem that, anything from the 5s and the 10s are a little bit more attractive at the moment rather than the very front of the curve. So I'd leave the 2 years alone and maybe looking more at the 5s and the 10s and the 20s. Okay, let's now have a look at Germany. Where's the German yield? So we see the German yields, they did come down. They shot up just on the whole sort of funding and infrastructure sort of spending, but that was much more in sympathy, I think, with the sort of the long end of the curve. So if we look at the long end of the curve, let's say the 10-year, you see that went up a lot. And if you look at the German 30-year, that hasn't even come in too much. But I think the point is that these will probably all drift down a little bit as we get more details, especially at the front end. So we're looking at the 1-year here and the 2-year. And again, that's going to be data dependent over in Europe. We had Lagarde last week saying that, maybe they're going to be data dependent. They may not necessarily need to be cutting that much. And the hawks are coming and saying they might not cut too much. But I think in general, the 2-year should outperform the long end because at the end of the day, we still have, a lot of issuance to cover all of the spending in Germany. And so I think, now that this has come in a little bit, it could, at a certain point, this yield here could be a buy on dip also in the 30-year. I think definitely the German long end could be underperforming not only the German front end, but also maybe sort of the US bonds. So if we look here, let's say just the 5-year, I mean, could that get down to, just maybe a little bit more, just down to the zone here, about 236, 234, something like that is possible. Again, if you look at the 10-year, probably in a range, let's say 265 could come down. That could be about the max. 270. I think down there could be an interesting opportunity there to be selling. So at this point, the Bund's going up in price a little bit, but if we get down there, I think that could be interesting sort of selling there to maybe short the German Bunds in that zone. So the 265, 268 zone, something like that. One thing which is interesting, if you just look at the shape of the curve, if you look at the German 2s10s, I mean, it has definitely steepened over the last couple of weeks or so. But if you compare that to let's say, the 5s30s, which is here, you see that it continues to steepen quite aggressively. And if you look at the 2s30s, it's also steepened a bit more aggressively. So the yield curve in Germany also is telling us that that continuing pressure of issuance to fund, as I say, the infrastructure and the defense spending will keep that long end of the curve definitely under quite a lot of pressure. So just in terms of, something else here. So I think what we need to be doing is to be, just in terms of Germany, is waiting just to let those yields come down as much as possible. As I say, down into maybe 265, you can do some kind of fib. There's a fib here. You see this down to this fib level, 265, 270, something like that. And then it could be interesting to be buying some put spreads. Also, what is quite an interesting one is just looking at the spread here between the US. So this is the US 10-year and the German 10-year. Let's see, is that going to fill this gap? You see this gap here. Is that going to fill up there? Maybe not all the way, but maybe in the middle, let's say 162, 163 differential. And if it fills up there, that would mean probably that the German 10-year yield, just the outright yield, is in the 260s kind of zone, which you just spoke about. So if we get the 10-year yield, just to have a look again, if we get the 10-year yield coming down a little bit, and then if we get the differential between the US and the German going just out a little bit to, let's say, 164, 165, if we get both of those, then maybe that could be the signal, if we kind of triangulate it, to be shorting the German long end. So you can do that in maybe 3 different ways. You could just sort of short outright the German long end, so FGBL on the futures, or the Buchsel on the futures, or maybe you could do sort of a bear steepener, so be shorting the long end versus buying the front end. Or another way of doing that would just be to actually be shorting, let's say, the 10 or 30 in the German space against the US sort of bonds. So that's something which is quite interesting, just looking at the bonds technically. If we just go over to currencies now quickly, we can see here that the dollar index, and keep in mind the dollar index is 58% euro, so it's heavily sort of euro and eurocentric. It looks as though that maybe just wants to break out a little bit, maybe up to, let's say, 105, something like that. That's a pretty nice sort of level there. But I think, somewhere around there, 105, 104, 80, 90, that could be an interesting level there, which will coincide also probably with the 200-day moving average here to maybe be shorting that. And again, you've got to say that it, probably wants to retest down here at 103 and even maybe down to sort of 102 level or something like that. Just going over towards the euro, which is kind of interesting. It had been breaking up, but it's sort of sold off a little bit again. So actually, you can see here the euro just showing a little bit of weakness, but a little bit of strength this morning. But really, the one I wanted to show you is the euro JPY, which we can see here failed again at the 164. So you can see here that's a pretty strong resistance level going all the way back to August of 2024. So that 164 level kind of failed again. And so what that is showing us is that the Japanese yen is looking pretty strong. So then if we sort of triangulate that and go across to the USD JPY, we can see here that maybe anytime if the USD JPY gets up to 151 or so, let's see, up about 151, 151.60, kind of up here. We have a cluster of moving averages. That could be quite, a nice short. Now, again, that's probably going to take, maybe a few days or a week or so, but that could be a little bit of a sort of a short there. Um, okay, so that's an interesting one to be looking out for there. Although just looking at the currencies, just want to look at the commitment of traders report as well. Just look at a bit of positioning. Um, it's interesting. So if you look again, a bit more tea. Okay, so let's just look at what's really stretched short. And again, this is data's a few days old now, but still kind of interesting. You see that the Swiss franc, the Canadian dollar, the Aussie, and the New Zealand very, very short, especially I'd say the Aussie and the New Zealand dollar and Canadian dollar here. So there's a bit of room. I mean, overall, the US dollar here has moved a little bit, sort of more neutral. It's actually sort of weakened a little bit here. But definitely a lot of these commodity currencies are very, very, very short. So any kind of risk on, there is a bit of a risk of a short squeeze on things like the Aussie, New Zealand, and CAD. So that's something just to keep an eye on. They're very, very short. And then in terms of the JPY, you see euro is quite neutral, but you see on the futures that the Japanese yen is extremely long, and even in this last week, it's moved right to extreme long stretch. So again, as I was just saying, it'd be nice to be shorting the Japanese yen, but it needs to probably, you want to see the US dollar squeeze up a little bit more just to maybe get some of this position a little bit sort of more flushed out here because it's not really great at those levels. Just why I've got this positioning update here. Let's also just look at some of the commodities. We see gold again still remains very, very long in terms of positioning. Oil could potentially be basing. You see it's at a quite neutral position. Look at the charts in a second. Copper is pushing higher and higher. We'll get onto that. So at this point, you see also the VIX is quite high. So gold kind of stretched. And if we look at some of those charts now, let's just look at some of the commodity charts. Actually, I want to start with copper because I've got some interesting sort of things here to be showing you here. So let's just have a look at the copper chart, which I will bring up here. And you can see that copper's at quite an interesting level. It's had a very big breakout. We're now getting towards the end of this Fibonacci extension, if you like measured moves in the fib. So we're now sort of almost in that zone. We also have a recent high at 5.18. So the question is here, is copper going to continue mooning here and break through, or will it maybe just sort of have a little bit of a push through, a little look down, and then sort of retrace a little bit? As I say, a bit of risk on overnight. But what's interesting is that with the Trump tariffs, there's been a huge amount of. Oh, actually, I didn't have it, but I didn't bring it up. What is interesting is that the amount of copper going into the US, there's hundreds of thousands of tons which are physically being shipped into the US at the moment. I have the inventory numbers just because traders are front running potential tariffs to be put on copper by Trump's administration. So the amount of copper being pushed into the US is huge. And also what's happening secondly is that the quantity of scrap copper leaving the US is actually being minimized. So there's not that many exports. So the point is that other markets, especially China, there's actually becoming a lack of copper in the physical market because it's all been pushed into London because of the differential in prices between the New York and the London price. Sorry, I meant to say pushed into New York because the New York price is much higher than the London price. And so you have all of this copper going into the US and none of the scrap copper actually losing the US, which means that sort of other players globally, especially the Chinese, might have to sort of pump up the prices and pay a little bit more to get access to copper. And so the question is, that's what's been happening over the last few weeks and a couple of months. And that explains this rather than some kind of growth story globally. So the real question is, has this gone its way? That's going to be pretty interesting to be looking at that. We can also just look here, as I say, looking at gold. Gold reached the top of its channel here, just taking a bit of a pause. But again, this is an incredibly bullish chart. So can you be buying up here? Probably not. Again, you have to start looking at sort of fib. The short-term fib here is like at 29.20. Longer-term fib, you're looking down at maybe 2900 or 2850. Pick your poison on where you want to re-enter. But gold just looks very, very strong. Silver, we can have a look at. Silver's come off a little bit, not as strong. So what's interesting, you see that gold has support because of sort of safe haven and central bank buying and sort of inflation risks. Copper, as I say, has some idiosyncratic kind of positioning and sort of inventory issues. But you see here that silver has not exactly joined the party. I mean, it did retest its highs, but didn't remain there too long. So it's interesting, is silver really telling us a little bit more about the state of sort of industrial demand? Interesting. It's kind of sort of the ugly cousin between sort of copper and gold at the moment. One thing I did want to look at as well, guys, just in terms of positioning, is just get this report from the Bank of America on the CTAs, which is a big part of. Oops, sorry, it's not there. Where is that one? Which is a big part of sort of trading, obviously. Here we go. So just kind of interesting to see where some of the trend strengths are, where they could be potentially very overstretched here. So you see here, this is the trend strength, and this is the model of the CTA, which is, the systematic trading trend followers. And we can see that something like on the European banking stocks in the 90th percentile long. So starting to get a little bit stretched there. Now, is that a forecast or a harbinger of what could happen to the Euro stocks? We can see that on the SX 550, it's only 65% the trend strength. So that's not as overstretched there. But what is interesting, it could be due for a short squeeze. If you look here in the US equities, you see the Russell 2000, which has been very heavily shorted. The trend strength here is 96%. So that's basically telling us that the CTAs have been massively short. It's a very strong trend strength, and that could be due for a short squeeze at some point. They've got a current spot and a couple of sort of buy triggers here. Interesting just to be looking at those kind of things. Other sort of trends which seem to be overextended. We've got USD JPY. It's very short at the moment. As I say, everyone's been sort of shorting that. Again, not really in the 90s, but sort of starting to get a little bit stretched. So that's about it. But really, the Russell's the one which is kind of interesting. And if we look just at the chart of the Russell, which I shall do in a second, let's have a look. Where's the Russell? As we know, it's been beaten down quite a lot. So just looking on the futures here, and you can see that it has bounced quite a lot and bouncing. So let's see if that's got a little bit more, because of course the point about the CTAs is that as these charts, let's say, goes up, and if everyone's massively short, they will actually sort of flip or exit their positions, which of course will cause an exacerbated kind of short squeeze. So interesting just to see how the Russell goes today. As I say, levels to be looking at here just on the ES. You can see here that we've got a 61.8 fib retracement level at about 57.95. Let's call it 5800. It's broken above the exponential moving average on the 200-day, which is about 57.33. What is going to be probably the key test is going to be the EMA, which we could, the simple moving average on the 200. You can see here, that's the one which also coincides. So this is a pretty key level here. And you've got to say that if this pushes up through, if we continue to get little rumors out of, I was going to say Hollywood, out of Washington, that the tariffs are not quite as severe as expected, I do believe that, the equities could sort of crawl up to, let's say, 58.75 or so. At that point, you probably, as a trader, have to make some kind of call whether you believe, ultimately this stuff is going to, the tariffs and Doge and deficit spending cutting and everything will slow down the US economy, the real economy, or whether it won't. And, we won't have too much data. We need to see data before we can make a decision about that. So just talking about data, one interesting thing today, again, it's just survey data. I'm still preferring hard data. We do have the S&P Global. We have manufacturing services and composite, the preliminary numbers for March coming up at 9:45. Again, all of those expected to remain in expansion territory, so above 50. What is going to be sort of interesting is to look at new home sales coming out tomorrow. We've got some confidence confidence data. And then towards the end of the week, we have final numbers for GDP. That shouldn't matter too much because it's like a third reading. But we do have the personal income and spending. That's got to be interesting, in real personal spending, just to see if the US consumer is still doing pretty well. And then, of course, we have some PCE numbers, which everyone will be looking at towards the end of the week. Okay, guys, I'll leave it there because it's gone a little bit long. So as I say, just sort of think about this whole idea of, where is the real economy going? Will it sort of, sort of support what the Fed said, like a 4.5% nominal GDP growth? Do we, have evidence of a slowdown? If we do have evidence of significant slowdown, I think the word from Powell, the feeling from Powell, at least in my estimation, was that, they would be absolutely prepared to cut if the labor market especially were to weaken. So we don't have a lot of that data for another week or two. And again, it's probably going to take several weeks, if not a couple of months, to really get more clarity about the tariff situation. So there it is. I think just in the meantime, it's probably a pretty good market just to be trading very short-term technically, if that's the way you like to trade, and looking for any overextensions. Okay, thank you guys. Hope that was useful. We shall keep on talking during the week. Thank you.